Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and watching the Market Chameleon live webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With one last look at the disclaimer, let's welcome Dimitri Pargamonic to the stage. He's going to be talking about screening call options with IV leans. How are you doing, D?
Good. How are you, Will?
Great. Sharing your screen, though, it's not. There it is. Perfect. Looks good.
So let me go back to the actual landing page. But what we'll do is today we'll take a look at a call screener. And the one we're looking at is particularly, we're going to look at a call screener looking for options as if you were looking at the ask price and evaluating from the buy side. Okay, so it's with a call screener to get long calls, and what we're doing is analyzing the markets from the offer, the ask side, which is the best available price displayed that you could act on. So first, let's go to the screener. Well, I think there's background noise from you coming.
All right. Sorry.
Yep. So on the screener side, if we hover over the main menu, we're going to go to long calls. Right. Click on that. And now we're on this long call screener. And we have, our different tabs here for filters. And then below we have a data table that screens based on the call option. So over here, long details here. These are the different call options for the related symbol. And we get all these data elements and statistics that we could screen by and evaluate that call. Now, here we see that, right now we're looking at a bunch of NVIDIA calls. So you could see NVIDIA has different strike prices, and they'll have different expirations that we could screen by and use our parameters to narrow down our choices of calls. So it's not only an NVIDIA here, it's, all the different, if we tab through all the different securities that have listed call options. We could also expand the expiration here. We're defaulted to the next monthly, but if we click on this filter, let's say we want to see all the expirations expire within the next 30 days. So what this will do is bring back even more items to analyze, because as you know, NVIDIA or other stocks have more than one expiration, most likely, that will expire within the next 30 days. So you can see here we have over 30,000 different potential options right now that we could analyze, and we want to start narrowing them down. So we could narrow them down using different parameters, but for our purposes today, we're going to look at an IV lean. So an IV lean, okay, over here, you can see here volatility. So we have an option IV lean, the option IV, the IV change for that option. And particularly, we see a lean that could be on an ask side, it could be on a bid side, or it could be on both sides, or there is no lean. And what is a lean? So when we think about a market, we have a bid and an ask, right? So like here, let's look at market data, right? This is the market data. So you can see there's a bid and an ask price, right? Bid and ask price. And what the bid price is, it's the best available bid. It's firm. So if you go and sell at that price, the other side that's displaying it is committed. So you could trade on it. the ask side, same thing. That's where somebody is putting out an offer or saying, I'm willing to sell it at this price. Well, that price is firm. As long as it's displayed, it doesn't trade or he removes it, they're obligated to sell it to you at that price at that moment. So these form what we call the market bid-ask spread. And the bid-ask spread, okay, it could be wide if there's an illiquid market and somebody's willing to buy, let's say market maker, and willing to sell. But if it's illiquid and there's uncertainty, price discovery, sorry, it could be a very wide market. It doesn't have to be $3.35 bid offered at $3.40. It could be $3 bid offered at $4, right? So, or it could be very narrow. And when it's narrow, obviously it's better for price execution because now you don't have to reach higher or lower on the market. There's better price discovery. It's more liquidity in there, and when this market gets squeezed, right, it could happen on both sides. Like, it becomes competitive and people are moving up their bids, and people are moving down their offers. Or it could happen also from one side, right? Like, let's say the original market was $3.35, $4. And then all of a sudden, somebody puts in a limit order, said, look, I don't want to sell it at $3.35, but I'm willing to sell it at $3.40. Well, that would tighten up the market. But the way the market tightened up was from the ask side being more competitive and narrowing that market, right? So what happened was somebody is indicating, hey, look, I'm a seller here. I'm willing to improve on the displayed market prices, and I'm giving the world, the market, my indicator, right here. I'm willing to sell it at this price. So that would be like an ask lien, right? That would be someone starting to compete and lowering their price that they're willing to sell it. Obviously, if you want to sell something, you want the highest possible price. If you want to buy something, you want the lowest possible price. But if you can't get it, you have to start competing and either lowering your offer, increasing your bid. And this is an important, to know when you're trading options or where this might be happening, especially if you're looking for your own better price execution or quality. Like, for example, if you are looking at this particular option, let's say it was $3.35 at 4. Well, if all of a sudden somebody says, hey, I'm willing to sell it right now at $3.40, well, now you have an opportunity to get a better price execution on that option, right? That opportunity could go away if somebody buys it. That is an indicator they're willing to sell it. And on the other side, if you're a seller, let's say you are a seller, well, now you have an indication, hey, there's somebody even more aggressive. Potentially you have more competition. And then at that point you could decide, well, now I have competition. There's somebody obviously trying to sell it. They're being aggressive. Maybe I do want to just sell it at this $3.35 before, more seller, because if that's where you're competing and you're worried that, if they start lowering and hitting the bid, the market could move lower away from you. So whatever side you're trying to do, it's still an important piece of data and information, right? But how do we detect these liens? Well, we need some help, right? Because we have all these different, 30,000 things, and, we need some help. Where are there liens right now in the market, and why do we think there's a lien? So we need a methodology to detect them that, we do using, the data that we have available, the markets surrounding it, how the markets move, to say, hey, this is where we think there's a current lien, right? So the ask lien would be where we think there's a lien coming from the offer. The bid lean would be a lean coming from the bid. So like, for example, let's see here's a bid lean. So this one we are looking at in the market in NVIDIA is 249 to 50. And our indication is that somebody stepped up the market on the bid side. Okay. This is on the ask side. So really, if you're looking to buy something, depending on, unless you have like a particular option, you may be looking to see if you could get a better execution where there's competition to sell. But if you notice maybe competition to buy and you are interested in that particular option, and you see where the implied vol is, what the implied vol did today, the IV rank of it, 50th percentile, it might change your mind and say maybe at that point you're not going to wait, or your limit order, you might even want to buy it, thinking that if some other market players start thinking like you, it could get bid up. So let's see what a bid lean would look like, right? So if we wanted to do that, we could click on this option, let's say in NVIDIA. By the way, I'll come back to this for screening. If you wanted to screen by these IV leans, we would use this. Looking for bid leans, ask leans, leans on both sides, where it looks like both sides are coming in. But let's just see what a bid lean, let's say over here, right? If we click on this hyperlink, December 19th, over here, this NVIDIA December 19th, 178 call, right? I'm going to click on it. It takes me to a new screen, which shows us the option chain, right? So the options chain, you can see the December 178 call. The offer is 250. Let's go to that one. 178 call right here, right? So what do we notice about the 178 call? Just like our screener, it's 249 bid and offered at 250. What we also notice is that here, the strike below it, the bid, right? The bid and offer are a little bit wider. This is 268 bid 270, 2 cents wide. The option above it is 210 bid 213, 3 cents wide. This one narrowed to a penny, right? So it's kind of an indication. Well, it looks like there's more competition, because if we base it off surrounding data, the markets are usually wider. All right, let's open this up. I'm gonna put spread IV lean, right? So you could see here, this is a penny wide. The market below is 2 cents wide. The market above is 3 cents wide. So this one looks like something might be going on where there's competition. It's really narrow. They're narrowing it. But now we need some more information. Where do we think it's coming from? Is it coming from both sides? Is it coming from one side, where one side is pushing the prices higher, or one side's pushing the prices lower? So what we do is use our option pricing model to help us out with that, because the option pricing model could give us a relative value, right? And that relative value is the implied volatility. So we see on the implied volatility bid, the option below the implied volatility bid is 37.6. The option above it, implied volatility bid, is 37. But what we see is the one in the middle is higher than both. So on a relative basis, if we just use the surrounding data, the closest options that we have, right? These are both expiring in the same expiration. They're both, all three are expiring the same expiration. They're all calls, and the strikes are all relevant, because they're, this option is in between them. So there's a lot of relevance there. So if we use that surrounding data, what we notice is, well, wait a minute, this one in the middle is bid higher than these two, right? So on a relative basis, we see that this is definitely looks like a a pump or something's going on in this option that we don't see in the surrounding options, the bid is increasing. We also could look at the ask side, and we see that this option's offered at 37.8. The one below, the one above is 37.3. But this option, the offer faded higher than the other two, right? So what's up with that? Like we're looking at very, we're looking on a relative basis and trying to assemble where, we're looking at options that have, close relationship. Yes, there are different strikes, but these are the closest data points we have. But why is this one in particular, bidding higher on the bid and the ask is fading? This looks, and the spread is tightening. That's an indication that there is a lean, an IV lean, right? Here we see an IV lean more than the surrounding data, indicating that there's a buyer interest. Now, this could be good for somebody looking to sell. You might have options and you're like, hey, I need to unload some options, or I want to do a buy rate, or I want to do, sell some options. This could be an opportunity where you're like, hey, maybe, I could either sell it at 249, or it looks like, they're stepping up. I could offer it 250, but this might be the option, where I get a better chance of getting a better relative price and execution. On the other hand, you might be very interested in that option, and if you think like, well, this option's underpriced and this is something I want to own, now you got competition there, that may make your decision different, where you're like, maybe I should just step up, because if this continues, the markets will move away from me, right? So that's a way to kind of look at the lean. So if we come back here and let's say we want to screen by leans, right? Let's say we want ask leans. We're looking to buy places where somebody might be pushing the market lower, making an offer, maybe aggressive, and gives us an opportunity to maybe sit on a bid, improve it a little bit, or take the offer. So to do that, we could just say option IV lean, I'm only looking for ask leans. Right? Now this has shown us, here's a bunch in NVIDIA, here's an Apple, Google, Microsoft. We could look by symbol. What if we just want Microsoft? Let's say we type this, there's 3 in Microsoft, that fit this condition. And then we could really kind of quickly look at what are the options: December 19th, 26th, January 9th. The IV ranks in them are 55%, 56, 61. Implied volatility is lower today, and so forth. So this filter makes it easier for us to quickly find those type of parameters, leans, so we can narrow down our choices and make quicker assessments. Right. So Will, I'm going to stop right there and throw it back to you.
Hey D, great job, my friend. Thanks for bringing these webinars to the Chameleon community. We'll see you tomorrow.
Right. Thanks everyone for joining. Stay safe out there, and see you guys tomorrow.
Have a great day, buddy. Hey everyone, thanks for joining another Market Chameleon live webinar series. It was a great one today, screening call options with IV leans by Dimitri. If you are new to the Chameleon community, please make sure you follow us on all the social platforms, particularly YouTube. Thumbs up, always appreciated. We do have a webinar this afternoon at 4:30 with Ryan from Options Robot. Always a good one. Jim, thanks for putting those stock questions in there. If anyone else has any stock questions that they want to leave for Ryan today, give them to me now. If you can't attend at 4:30, and I'll put them in front of them. I'll give it a couple more seconds. Again, thumbs up, always appreciated. Everyone have a safe trading day out there, and we will see you tomorrow. Bye.